8-week T-bill yields are soaring. Buy Treasuries when bombs fall. Hello, members, super savers, and bond course fans. I hope you're healthy and well. So, at the time of this taping, President Trump announced the U.S. had successfully destroyed 3 critical nuclear facilities in Iran. We'll need to wait and see how it will develop from here and how markets will react when they open on Monday morning. But the American intervention is just the latest turn of the escalation in the Middle East. And while I can't predict the future, we can have a look together at how bond markets reacted at various stages of the conflict in the past. And maybe our observations will help you to put events into perspective and develop a framework for how to think about geopolitical conflict and your treasuries overall. And in particular, whether treasuries might be losing their safe haven status in the middle of peak uncertainty. So let's look at the last week and how we try to make sense of what we saw. At the close of market on Friday, the 8-week T-bill was at a near record yield of 4.55%, while the 4-week T-bill was 35 basis points lower at 4.2%, even below the Fed's target rate range of between 4.25% and 4.5%. These somewhat baffling signals seem to have some of you wondering what exactly is going on in the bond market right now. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Why are 8-week T-bill yields so high, and should investors pick some up? And in this section, we're also going to talk about some of the perplexing moves we're seeing across other short and longer term treasury maturities that you may have or are considering for some of your personal portfolios. 2. How did treasury yields end the week? And 3. What are the yield expectations for the upcoming week's treasury auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why are 8-week T-bill yields so high? And should investors pick some up? As I already touched upon, we saw some confusing signals this week across the treasury maturity spectrum. So let's focus on 3 concrete examples before we move on to our usual wider treasury market update later on in this video. Example 1 is the 10-year treasury, which many in the industry consider to be the benchmark for the overall bond market. And the big story here is that the 10-year can't seem to make up its mind in which direction it should be headed. Here's how long-dated treasury yields have tracked since June 9th, before the craziness started. When the tensions between Israel and Iran first reached a boiling point, the yield on the 10-year initially declined by 13 basis points, from 4.49% on June 9th, the Monday of the decisive week, to 4.36% on June 12th, the deadline that Trump had set Iran for agreeing a deal. So far, so expected. Rising geopolitical tensions normally lead investors to buy into treasuries as a safe haven, and this extra demand pushes up prices and lowers yields. Remember the fundamental law of bond investing: prices up, yields down. But then something surprising happened. When Israel actually struck Iran, yields on the 10-year went up by 10 basis points in just 2 trading days, from these 4.36% on June 12th to 4.46% by June 16th. This could only have meant that investors were selling the 10-year just as the bombs were beginning to fall. And this shock selling at an unexpected moment caused quite a bit of soul-searching in the media about treasuries losing their safe haven status, as we already discussed last week. Now, the 10-year still had a trick up its sleeve, so to speak, and over the next few trading days, its yield started to go down again, indicating that investors were returning. And net-net, as of close of market for this week, the yield on the 10-year stands at 4.38%, down 11 basis points versus our starting point of 4.49% on June 9th. Yields on the 20-year and 30-year have also trended downwards over the same period, as you can see here. So what do we make of this roller coaster-like price and yield movements? Now, I think the fact that the yield on the 10-year is down net-net as of the time of this taping versus June 9th confirms that the world still sees U.S. Treasuries as a safe haven in the global financial system. There's just no obvious candidate to fully replace them. That said, what we might be seeing is a bit of a balancing out. Investors may be directing some of their safe haven purchases into shorter maturities. More about that in a minute. And or splitting them with other top-rated government bonds such as German bunds, as we covered in detail with our members on this Member Live from Friday, for those of you who might be interested. Some investors may also be diversifying into real assets such as gold. So perhaps the US might be moving away from having a virtual monopoly as a safe haven. But I think Treasuries are still very much seen as one of the world's foremost safe investments, and they still are the most liquid instrument in this category. And if the zigzagging yields of the 10-year weren't confusing enough, let's take a look now at our next two examples. The 4-week or 1-month Treasury and the 8-week or 2-month Treasury could almost be siblings, given how close they are in their maturities. However, the yield on the 1-month is down since June 9th, while the yield on the 2-month is up. As you can see here, the 1-month went from 4.29% on June 9th to 4.2% as of the close of market on Friday, a decline in yield of 9 basis points, with the strongest decline seen on June 12th and June 13th, when Trump's ultimatum to Iran expired and the attacks began. Remember the inverse relationship between bond prices and yields. This could only mean that investors were buying the 1-month as a safe haven investment. And even more so than for the 10-year, the buying started immediately when the conflict turned hot. If my theory from before is correct, that many investors last week preferred shorter dated treasuries as a safe haven, this would explain why the 1-month became suddenly so popular that its current yield seems almost stuck at 4.2%. Even though this yield is below the Fed's target rate range of 4.25% and 4.5%, as I touched upon at the start of this video, and investors could get higher returns on even an overnight deposit with the Fed or another financial institution, assuming, of course, they have access to such a facility. But if investors were really buying the 1-month in significant amounts as a safe haven, why would they at the same time flee from the 2-month with its not that much longer maturity? Because if we look at this yield table, we can see that yields have shot up by 19 basis points for the 2-month, going from 4.36% on June 9th to 4.55% as of the end of this week. That's quite a dramatic move for such a short-dated treasury, especially since the Fed didn't change its rates at all at the latest FOMC meeting. Or put another way, is there something wrong with the 2-month? Now, I don't know for sure either, but my personal theory, as we've been discussing in our member zone quite extensively the past week, is that the 2-month is being caught up in the uncertainty around our budget and the debt ceiling. As Treasury Secretary Bessent just reminded the House Ways and Means Committee on June 12th, the U.S. may hit the debt ceiling and run out of money as soon as August if President Trump's One Big Beautiful Bill does not get approved and signed by July, and the second half of August happens to be roughly the timeline for the 2-month Treasury if you were to buy it this week. So maybe investors stay away from this maturity because they just want to avoid any instability around the time they'll be due their money. And by the way, similar concerns seem to apply to the 1.5-month Treasury as well, whose yield has also gone up a bit, as you can see here. This coming week's 6-week T-bill auction is amongst the first in this category to mature in August. That said, and if you follow this line of thinking, the market still seems to be fundamentally optimistic about our debt ceiling deadline. The 3-month went down in yield a bit, indicating more buyers seem comfortable that the budget and debt ceiling crisis should be behind us by the second half of September. There's always uncertainty and volatility in the markets, but even more so in the world these days than we appear normally accustomed to, and it may even go on for a while. Nonetheless, I remain fundamentally optimistic as usual and don't think that I personally will be betting against America anytime soon, meaning that yes, I am tempted to pick up a few of these 2-month treasuries. Many of you ask about what we here at Diamond NestEgg call blip yields. Well, here it is, a blip yield, and this blip yield can look attractive if your basic assumption remains that the US government will not default on its obligations, as is my standard assumption at the time of this taping, even if there might be a government shutdown. But as I always say, that's me, and everyone's financial journey is different. I don't have a crystal ball either. So drop a comment below and let me and the community know, are you planning on picking up some more T-bills? And if yes, which maturities? Or are you thinking longer-term T-notes, bonds, and annuities? Or possibly something else altogether that might be a good diversification for your bond portfolio in uncertain times? YouTube members, stay tuned for this month's member video with a special deep dive into how you can diversify your portfolio with international bonds and under which conditions this might even improve your overall return based on historical examples. Now, let's move on to the wider Treasury market and the next section of today's video. How did Treasury yields end the week? Let's have a look at our usual chart with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. The 1.5 month and the 2 month were up for the week, as we just discussed extensively in the previous section. The 4 month was unchanged, and all the other maturities were down for the week, with the biggest drops in the medium-term notes, as you can see here. So more signs that investors might not be exactly fleeing from Treasuries, but continue to buy across a wide range of maturities, with just the exceptions we discussed before. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 2 month through the 6 month, as well as the very long dated 20-year and 30-year T-bonds, continue to be up for the year so far, while the 1 and 1.5 month and the maturities between 1 year and 10 years are down, with the biggest drops to be seen in the 3-year and 5-year. Again, the large drop in the normally more or less stable 1 month shows that many investors might be piling into this short-dated T-bill in times of high unpredictability. And the long end rise in yields could be due to a multitude of factors, from a strong improvement in consumer sentiment to improved tariff and trade talks, and the lower probability of a recession and rate cuts, as we discussed last week. In other words, the yield curve may just be slowly uninverting. Now, as we all know, these are somewhat crazy times we live in, and as always, things could change very quickly. So as customary, we'll keep our eyes and ears on things and keep you posted as things evolve. Do also keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. So, now that you know where Treasury yields ended this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 2-year, 5-year, and 7-year T-notes will also be auctioned off this coming week. None of these are reopening auctions, so the coupon is still to be determined on auction day. The 2-year floating rate note is also on the auction schedule. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 2-year T-note auction, the 5-year T-note auction, and the 7-year T-note auction. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, members, super savers, and bond course fans, I hope you enjoyed today's video and learned something new. And for those of you with Schwab who subscribe to Your Financial Journey, check out this latest highly requested video here from Ava, which walks you through step by step on how to keep your money even safer at Schwab via the recommended Authenticator app. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses. I've also linked all the details on Ava's Schwab tutorial, our bond courses, and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.